have both mics. That is the mic that goes to, so as you know, we have recording in the back.
Yeah, I'm going to do that because I have the...
And we have recording in the back. That's going to go on YouTube. So give it about a month. If you go to phoebepasadena.com, real complicated, right? F-I-B-I Pasadena.com, you will find at least 3 years worth of meeting videos there. They are free. Did we mention networking and education? So now you have access to at least 3+ years worth of meetings that are based in education. You have access to a meeting that brings you networking. And you have access to Jeffrey, who's going to tell you how you can invest in the Southern California market and actually make it work.
Nice. Thank
right,
you.
All yours.
So I guess for starters, I just want to make sure I'm good technically. Are the mics doing what they're supposed to? Can everybody hear me?
Yes,
Online as well? Alex, yeah?
Yep.
Beautiful. Thank you so much for the warm introduction, and thank you everyone for coming out. It's good to see some familiar faces. And as you know, in follow-up to that great introduction, I did start out as a multifamily investor. So I was doing that before I got into real estate as a primary way to earn a living, and decided to focus in multifamily. Just from my own experience and my own investments, really made a lot of sense. We look at the Southern California market, we look at everything that's going on, and it just was just a great way to make money. You know, having toiled away in the 9 to 5, looking at more of traditional investments, you get a lot of years behind you. You're working, you're doing the grind, and then all of a sudden you're like, how am I going to get to where I'm going, doing what I'm doing now, if I'm just investing for retirement and stocks, bonds, whatever. There just wasn't enough there. And real estate was kind of like the light bulb. It went off, and it's like, wow, there's a better way to get from point A to point B. And I decided to devote all of my time. I had my own company. We were renting video equipment to the live events industry. So a lot of hustle, a lot of on the go, a lot of travel, all these things, project management, all these things that kind of lend themselves well to working with people in real estate. And couldn't have been happier, the day I transitioned from that space into real estate. So definitely a great way. So I work as a licensed real estate agent. Obviously, I'm working with buyers, I'm working with investor clients, and teaching them how our market works, how you're able to build a plan for yourself. And a lot of that is done through a lot of time spent educating, learning, planning, all that stuff on the front end. So along those lines, as Christina mentioned, I also host my own meetup group. It's also educational. We're not trying to sell anything. We want people to come in. We want them to network. We want them to come away with some useful information. So at the end of the day, whether you're looking to Southern California, you're looking at a state, you're flipping, you're doing multifamily, single family, doesn't matter. Come on in, learn something, listen to the speakers, network, make a connection, and that's what we're trying to do. Because as Kirk mentioned, it's all about networking. Maybe someone knows someone who can help someone, and it's always great to make a connection. So we are typically on the 4th Tuesday of every month. For right now, we're online. When we weren't, we were in the East Valley area, alternating between Van Nuys, Sherman Oaks area, and North Hollywood. But for now, we're still online. So our upcoming events, you have to kind of find us on meetup.com under Multifamily Investor Network, Los Angeles. So if you join the group, you'll get notifications. On Tuesday, our guest presenters are Tommy Barrow and David Guevara of First Centennial and Momenta Capital Group. So these are some lenders that we work with in the 2 to 4, or I should say 1 to 4 unit conventional space and commercial. They're going to be talking about all the different loan products that they offer, where the financing landscape is going with increasing interest rates, and just a lot of good stuff, a lot of good takeaways. In May, we're going to talk with Tony Watson of Robert Hall. He's going to talk about planning your tax strategy and what a better way to do it heading into the 2022 tax year. So that gives you a lot of time to plan. So my brokerage, Buckingham Investments. So the brokerage has been around in multifamily dating back to 1963. We were founded by Jack Buckingham and Marty Stone. And these guys were looking at real estate to really understand how it worked. So Jack was actually working at Raytheon as a computer programmer working on, I believe it was like missile launch codes and stuff. So he definitely had a head for numbers. And a lot of the data that we still use today, which I'll show you some of that in our presentation, historical data, where multifamily was, price per square foot, where it's going, they compiled all that data that we still use today, which is super interesting. So first and foremost, we work with investors to build their net worth through strategic multifamily property acquisition. So like I said, we're providing a lot of experience, education, market data. We want everyone to understand the nature of the investment, the market, and how it works before we ever suggest that somebody says, hey, I just need a 4-unit property, right? I've got this much money. I just want to buy because I know it's good. Well, we're not going to be able to do that. We're going to have to take a couple of steps backward and kind of show you how it works and why you're doing it, because we want to empower our customers to understand what it is that they're buying and what they can achieve. So we're full service, everything from helping with property selection and valuation, getting you into contract, getting you across the finish line through escrow, and resale. You know, when you get to the point where you want a 1031 exchange or do a cash out refi and buy something else. And also part of what we do is provide a very vast referral network of professionals. And not because we are compensated monetarily for it, it's because the people we work with are really, really good. They're able to help get deals closed, everything from lenders, property managers, leasing specialists, contractors, whatever you're going to need throughout the process. So with that background out of the way, we'll get to SoCal multifamily, what investors need to know. So the big thing is we want to talk about is what's driving the market here in Southern California, why people are investing, why they're having success. So what we do know is that there is a very profound shortage of available housing units in our market, and it's been decades in the making. So this isn't something that happened 2 years ago, 5 years ago, 10 years ago. This has been going on for decades. Southern California in particular has not been building nearly enough housing to meet the demand. So as a result, prices are going up. And that's in 2 areas, not only on the price of the buildings, but also we're seeing that on the area of rents, how quickly they're going up. I speak from experience. I can tell you that I have holdings where my rents in a 7-year period are double what they were on acquisition. And even with, you know, certain legislations that's come about, it's no secret. We have, you know, statewide rent control, and everyone's trying to get a handle and trying to do this type of cost containment. And it's just not working because it's supply and demand, and there's just not enough supply. So as an owner and investor, you're going to put yourself on the right side of that equation, on the supply side. Obviously, the pandemic, we all know what's happened since 2020. That's actually accelerated the problem even further. So a little bit more info when we talk about this profound shortage. We can't really talk about it without getting into some numbers that I wanted to share with you. So the 2020 census data has revealed that California actually added 3.2 times more people than housing units over the last 10 years. So 2010 to 2020, we're, you know, going kind of deeper into this hole of not having enough units available. But when we look back even further, we can go back for the 30-year period between 1980 and 2010, and the state had a shortfall of over 3.5 million housing units. So this is before we have that, you know, census data And as you can see, the problem and the scope of it keeps building. So the Public Policy Institute of California also had a study, and part of it was that they said that there is, they use that to set, housing goals and housing starts, and they really want to try and build their way out of this mess. So they set a goal at 180,000 new housing units a year. So that should be, where they're going. Yet what we do know is that the annual production, if anything, has slowed from 147,000 units. So we weren't even hitting what the targets are. We were already tens of thousands of units short. During that 20 to 2010 timeframe, we needed 180, we were building 147,000. But since 2010, for the last 11 years, we're building on average just 71,000 units per year. So we're not even moving in the right direction. And I was too quick on the clicker, but given the scope of what's going on, any gains that we're going to make would be a miracle at this point. So additional market drivers. So we have the shortage. We can kind of look at why. We can look additionally why prices are going up. Well, we also have a shortage of available land in which to build, right? We're very housing dense right now. There's certain areas it's just housing after housing after housing. There's really nowhere where you can build unless you're going to be, knocking stuff down. And that doesn't make a lot of sense due to construction costs. There's a lot of downzoning in areas around LA where you could have multifamily units that are grandfathered in, but all the new zoning could be R1, R2 residential, so you can't even do anything with it. If you knock down your 5-unit property, you could put back a duplex. That doesn't really make sense either. In addition to the land shortage, we're bordered on two sides by oceans and mountains. So that's still part of the issue there as well. And to some extent, it's a lot more expensive to build new units than what current market values are for B and C class properties. So those are the ones that the investors are able to get better returns on. So we're seeing the bulk of the new developments in and around Los Angeles being Class A properties. I guess, you see the big developers like IMT, right? They're kind of popping up everywhere with their luxury buildings and gymnasiums and all that good stuff in there, because that's where they're able to get the returns from their costs. So all this is pretty much more of the same problem, right? It's causing lack of affordability, especially for first-time buyers. So you have millennials, you now have Gen Z starting to come of age, and people want to buy housing, but prices are going crazy. Nationwide, we're looking at increases of over 17% last year. We have a rising interest rate climate, which is making things even more expensive right now, with interest rates for conventional buyers approaching 6% right now. The commercial space is a lot better. It's still in the mid to low fours, I'd say, as long as you're debt covering. And inventories. We are seeing historic lows of inventory. So that's evidenced by anybody that wants to go out and buy a property. You're looking at 12, 18, 20 offers, and until we get more inventory online, even the higher interest rates, if anything, may cool the market somewhat as far as bringing it into equilibrium, but we really don't see prices dropping based on what's going on in the market right now. Economy. Why Southern California? Well, California ranks as the 5th largest economy in the entire world if it was its own country. So we've got a very, very strong economy, so much so that California makes up 14% of the entire nation's economy. And even here in SoCal, this area is a leader in rounding out the state for a lot of top industries. So there's aerospace, tech, entertainment, tourism, bioscience, tourism. I don't know if I've forgotten anything else, but definitely a very, very strong economy. So I wanted to share with you how that translates into multifamily housing. So this data was taken from CoStar, and they're a leading source for data. And what their chart is showing, they're going back all the way to Q1 of the year 2000. We've got 4 distinct lines going. So I'll just kind of break it down for you so you kind of know what we're looking at. So first of all here, yellow represents the Los Angeles market vacancy rates. So you can see for the most part, you're sub 5%, except for the onset of the pandemic. We have a sharp spike here in vacancy rates, and they've actually dipped lower than even what they were pre-pandemic. So the yellow represents the whole of Los Angeles. All of our other colors represent Long Beach and port cities. So San Pedro, Long Beach, we do a lot of work in the South Bay area is where we specialize, even though we do sell properties all over Southern California. So we have a very keen interest in this area. But what you want to look at here is what they're calling 3-star. So that's basically your B and C class property versus your 4 to 5-star, which is your A class. So what I want to show here is obviously the extreme volatility in the Class A properties. So obviously tied into the economy, right? Economy goes bad, people don't have enough money. The first thing they're going to do is they're going to move out of their fancy building, and they're going to find something that's a little bit more affordable. So you have some kind of baked in safety here for your investments, knowing that if you have a weakening economy, you're going to get some movement from your A-class properties into your B and Cs. As well, okay, so they're also breaking down the 3-star versus the green, which is everything combined. So we're paying a lot of interest in the orange. And if you look at where that's been for the bulk of it, definitely under 5% and pretty historically low now. We're under 3%. And obviously, the reasons are why I just shared with you previously. So any questions on that? No, we're good. So here's another graph just to kind of show people what's going on, because there's a lot of talk about moratoriums, evictions, rents, like people talking about how volatile the market is right now. And we're actually not seeing it. This graph was done by one of our partners that manages a portfolio of close to 4,000 units in the South Bay area. So what we have here is we're graphing both the collections and the vacancies at end of month, going back approximately 13 months. So if we look at the bar chart of the blue, we're looking at rent corrections, and we're looking at the percentage of collections across. And we can see that we are pretty much between 96 and, believe it or not, close to 102%, which you have to ask yourself, how are we getting more rent than we're supposed to? Just some deferred rental payments, perhaps through government assistance till that comes online. And in the month it's recorded, so some of the shortfall from previous months gets made up when the payments start flowing. So that's how we're able to explain that. Again, this is a vacancy graph from their own portfolio. So this isn't CoStar, this isn't Long Beach Ports, this is just all their properties, all their doors that they're managing in South Bay. So that's everywhere from Inglewood, Hawthorne, San Pedro, Torrance, Long Beach, Harbor City, pretty much any South Bay community. And it's basically showing this orange line. We're looking along the axis here on the right on our percentage vacancy. And you can see right now we're actually under 2.5% and trading in a range in the last 12 months up to just under 4.5. So again, pretty narrow. So what does that translate to in a real world example? If you have a unit turn, as fast as you can get that unit ready for rental, you have a tenant. straight up. Pretty much same graph here with respect to the vacancy at end of month, but instead of rent collections, we're looking at amount of units leased across their portfolio. So that's in a range of 40 to 60 units every month are coming online and getting rented. So rental activity in the area is strong. So now that we looked at the market, we looked at vacancies, collections, all that good stuff, what's driving it, we can ask, okay, why do people want to invest? Like, what are they trying to achieve when they're buying multifamily in LA? So just to sum it up for you, there's a handful of reasons. First and foremost, it's to build net worth. So coastal communities, Southern California, lends itself well to building your net worth through real estate, and that's through your equity. And there's a lot of ways that you do that, obviously through appreciation, through all types of things, but first and foremost, appreciation is your friend. There's other elements to the returns. Those, I don't want to say are somewhat secondary, but it depends on your goals. But when you combine it all, the returns get pretty lofty, and we're going to talk about that. Also, the good thing about building your net worth is you can create generational wealth. So as you know, you have the ability to do tax-deferred 1031 exchanges, keep repositioning that equity, acquiring more property, and being able to take advantage of the tax code, which is very, very favorable. If you have a family, you have heirs, on your passing, that cost base resets to where those properties are at that point in time, and you're basically starting all over again. So that's a great way to kind of use that for your wealth strategy. And I think it's also worth saying that all of this is built around a long-term strategy of being in the market. So it's not a question of, hey, I'm going to get into real estate, I'm going to make a bunch of money in the next 18 months, and then I'm out, I'm good. We don't have a crystal ball. We don't know what the future looks like, but we know that in the long term, with the data we have, that we're reasonably confident that we're going to achieve certain numbers. So long term, and what we like to call it in the brokerage is get rich slow, because it's going to take some time, but you're going to get there. So how do we do that? How do we build out? It's all fine and good to say, okay, we're going to build our net worth, we're going to get a lot of equity. Like, what are we trying to do? Well, believe it or not, our investment strategy looks like the future value of money equation. How many of you have a finance background, have seen this formula before? Anybody? Yeah, a handful of you? Okay. So this is not unique to real estate. This is not something that we came up with. This is the mathematicians, and these are what financial planners use. So say you're working 9 to 5, you're making $300K a year, you have a family, you're like, hey, I want to retire in 20 years with $5 million. How do I get there? Well, your financial planner is just basically going to punch in a bunch of numbers and say, it's the wrong button, but hey, how much present value, right, which is how much money you have today or your initial investment, we're going to say, hey, if you've got this much money now to invest and we can get you R, the rate of return, which we don't know what that is right now for the purposes of that discussion, but we know we want to retire in 20 years. So that's N, right? We're to the power of N, we're 20 years. And what we are trying to solve for, well, actually we do know in this case that our future value is we want $5 million. Great. So we have to figure out, or we can solve for rate of return. And that's what the financial planner is going to do for you. He's going to be able to solve this equation because we have 3 of the 4 variables. Well, what we're doing is the exact same thing, only we're doing it with real estate, because we look at our models and we're able to model for a certain rate of return. So believe it or not, this is our investment plan. So when we talk about all these values, future value, present value, rate of return, number of years, it's pretty simple. Just by saying, I'm going to invest, we'll use an example of $250,000 in real estate. And we're going to do that for 20 years. and we're going to get a sustained rate of return year on year of 25%, we're going to be worth over $21 million at the end of the plan. Thoughts? Yeah. You're going to ask me to show you the money, right? Where are we getting that? That's why I'm here. Cuba Gooding Jr. Show you the money. So a lot of the reaction is exactly that, is where 25%, how am I getting that? And a lot of people actually not understanding that that equation is exponential, look at $21 million and go, I don't get it. 20 years, 250 grand, 21 million, even at 25%, I don't know how you're getting there. But I'll show you how we do. So with those numbers, we just plug those into the equation. And like I said, we're trying to solve future value. We know in our plan we have 250,000. We're ready to buy something. I'm talking about 25% returns. You guys think I'm crazy? That's fine. We'll get there. And we're going to do it for 20 years, and we're going to get you 21 million. So just want to show again how that works on the exponential part of the equation, because again, it does happen slowly. So it's going to take 10 years at a return on equity of 25%, and we're only going to be at $2.3 million. Well, that doesn't sound so great, right? We're invested 10 years, 250 grand, 2.3 million. It's not terrible, but it's taken us 10 years to get there. But look what starts happening now in the period of year 10 to year 15. Our return actually triples, right? 2.3 million, as it starts growing exponentially, is now 7. And the same thing is happening in the next 5 years, year 15 to 20, we're tripling again. So it's very much get rich slow. We need time on our side to accomplish these goals. This is not happening in 2, 3, 5 years. And this table also illustrates that if we come up somewhat shy and can only pull in return numbers of 20%, or if we exceed it at 30, how much those values change, because it's exponential. So it's pretty mind-blowing, right? You can, for an extra 5% return over that time frame, you'd have more than double the money at the end of the plan. So kind of gives some investors a little bit of motivation to force that appreciation and up your returns. So where we're getting the 25% comes from 4 different elements of return on your real estate investments. So as I said initially, appreciation is the cornerstone of the model. You buy a building for $1 million, it goes up 10%, you have $1.1 million. It just made 100 grand in appreciation. So that's part of your return, of course, and cash flow. Cash flow being, what is my cash in hand return annually based on the money I've put down? Call it the down payment, initial payment, whatever it is, once all the expenses are paid on the property from the income. You want to be left with money in your pocket. You don't want to be supporting that property financially out of your 9-to-5 job just to get appreciation. So cash flow is very important, and it is achievable in our market, contrary to what some people say on some days. They're like, hey, you can't cash flow here. Third one is equity buildup. So this happens through amortization. So if you're buying with a loan, you're buying on leverage, right? Say you put 25% down and you have a loan for 75% of the value of the property. So every time you're collecting your rents, that income is going towards paying down your loan. So every month there's an element of principal that gets paid down. Well, that money is coming from your tenants. It's not coming out of your pocket. So when that principal gets paid down, guess what's happening? Your equity is building up. So you're earning a return there. Lastly, you also have tax benefits. So lots of different ways. I'm not an accountant, but I can just tell you on the easiest ones, your building depreciates every year. Straight line method based on the cost of the building, that's a benefit to you. Your interest on your loan is also tax deductible. So there are tax benefits, and you are earning returns there because at the end of the day, if you're paying less taxes and you're holding on to more money, you're earning a return. That money is working for you. It's doing something when you invest. So let's take a look at what that looks like. So to deal with the first one, we want to talk about appreciation in the market. How are we able to build out a model for our appreciation, right? Where does it come from? Well, what we did here is dating back to 1965, right up to the end of 2021, we have a graph showing the price per square foot. This is all closed sales in the South Bay area of Los Angeles. So this data was pulled by our founders way before the MLS, when everything was recorded manually on paper. You had these little cards that would show the property and the square footage and what it closed for. And literally from every single closed transaction, the price per square foot was calculated. So if we go back to 1965, we were at $14 a square foot. And where we sat at the end of last year was $485 a square foot. So when we look at a 56-year compounded rate of appreciation year on year, when we smooth out all the volatility, because real estate, contrary to what's been happening for the last little while, is not a straight line up indefinitely. So somewhere, some point, the music stops, right? So is that a softening? Is it a crash? Nobody knows. But what we do know is, through every single cycle, a lot of things have happened. So whenever the market's gone down, it's always recovered past the previous high. So it's about being in the market through the cycles that you can take advantage of the upcycle, right? Because we're not really earning 6.5% year on year. We're averaging out through the life of our holdings, right? Like if we're in 2008 right here and we go from $329 a square foot to $262, I can guarantee you didn't get 6.54% appreciation. You got negative a big number, right? So what we've done is we've smoothed out all this volatility. So if you're in that market long enough, you're going to strive to pull the historical average. But we want to be a little bit more conservative. So we actually take that number and we dial it back to 5%. So that's what we model when we talk about the appreciation. And we're kind of reasonably confident that what's been going on throughout time is going to continue based on our market drivers, right? We're not just coming out and saying, oh yeah, well, hey, this happened, so it's just going to keep happening. We're looking at what's going on behind the scenes and what's driving it. And obviously, we can't promise anything, but I speak on behalf of myself as an investor. I'm pretty confident that, there's nothing here in these cycles that scares me. If anything, we probably came out of the worst cycle anyone's seen in a long, long time. And given the underwriting and the fact that there aren't garbage loans out there, we don't anticipate seeing this on the next go round. So this is pretty interesting. I'll try to move it along, but basically we also graphed the recession recovery cycles of the last 3. So quickly, it's pretty small, but what I want to show you is from 67 to 81, we had 4 years till we were able to recover our pricing where we were when the market went down. But once it started to go up, it went up approximately $89 a square foot. But we were starting at 17. It went up, the price per square foot in that recovery cycle, 408%. That's a huge, huge number. So much so that in the subsequent recovery cycles, it was significantly less. 81 to 91, it was actually 1 year. The price flattened literally $1 a square foot. That's it. That's all that happened. That was our real estate price per square foot recession. But on the back end, I think we only went up 65% through the rest of the cycle. So the dip wasn't that big of a dip, but the upswing was nowhere near our 408%. So no one really knows what's going to happen as cycles recover or where they're going to end. So same thing, when we peaked in 07, the length of the cycle was longer. I want to say it was, I think it's 8 years. Sorry for the small sizing of the graph, but it went up approximately 189% till the next peak. So you could see 3 very different recovery cycles on our price per square foot. So what we wanted to do to take a look at the numbers and say, okay, well, everything went down 07, 08. If we were to project going forward these 3 recovery numbers of 65%, 189, and 408 or 406, what would that look like? So we actually projected that forward from our previous low and said, okay, if we look like the 81 to 91 recovery, we would top out at $544 a square foot. If we were looking at the previous recovery, the 91 through 07 recovery, we'll top out at $954 a square foot. And going back to 67 to 81, $1,667 a square foot. So that's based on actual percentages of what we've seen in the past. So obviously, this is not meant to be a projection and tell you we're going to land here, there, or the other place. But I can tell you, we're kind of getting close to the 544, whoops, because we finished last year right up at 485. But that's not really telling us anything. And so much so, a little bit more, if you look at what happened from, where are we at here? We are 2018. We went from 407 down to 398 and then up to 422. We actually had a little dip in 2019 in that market. So does everyone remember if you guys were coming to Phoebe in the fall of 2019, November?
Federal rate increases.
Right.
Like October, November.
Right, but not only that, if you were in this room, people were probably talking about the inverted bond yield, which was signaling our next recession. Guys, remember that? Everyone was kind of like changing their behavior. We're at the end. This is done. We're heading. There's impending doom. And people didn't talk about softening of the market. They didn't talk about recessions. They were talking about the not stock market, but real estate. They were talking about the impending crash. Do you remember that? Like people were using the terminology of the crash. So we don't really, I guess, partake in those conversations. We just really want to kind of have expectation be realistic that says, hey, this is what's happened, and literally anything can happen going forward. But for me, there's a reasonable degree of confidence that, you know, we'll go through our dips, we'll hit our big appreciation numbers, and that's where we're going to make our returns. It's just, there's no magic there. It's just straightforward. So part of the returns that we're trying to get, getting back to the whole 4 elements of return, are appreciation, cash flow, equity buildup, and tax benefits, is as real estate investors, we have something that's really awesome. And it's not just appreciation that we get in California, but we get the power of leverage. So as an example, if we buy a building, for $500,000 and we pay all cash, and we said, hey, the market appreciates on average 6.54% long term, we're going to talk 5% appreciation. So great, we have a $500,000 building. We took all our cash. We got 5% appreciation. We made $25,000. Great. It's a 5% return. That's what we got, 5% appreciation, all cash. But we're buying with leverage, right? We want other people's money. We want the bank. We want partners. We want private lenders. We want people with money. We're going to say, yeah, we want to make some interest rates. We'll be the bank. You guys run your property, do your thing, as long as we get paid back. Well, great. We can take that same $500,000, but we're not buying this little $500,000 property with all of our own money. We're paying 25% of the property with our own money, and we're borrowing the rest, the 75%, the biggest component. And why are we doing that? Does anybody know why we're doing that? Leverage. Exactly, because we bought a $2 million building, and if we get the same 5% appreciation, we've actually appreciated $100,000. Well, it doesn't matter who your lender is. They're not getting any of that. They don't participate in your appreciation. That's yours. That's your building. They get their loan repayment. They get their interest. They're happy. We're happy. But this is how we're able to supercharge our returns, because this is, although it's 5% appreciation, it's not a 5% return, because you put down $500,000, you got $100,000 appreciation. You actually got a 20% return on your investment, because you only put down your $500,000 and got $100,000. This is just basically saying the same thing that our picture did. Any questions on that? Nope, we're good. So now we can actually throw some numbers towards our 4 elements of return and just give you an example that says, okay, appreciation, well, we're going to say 17%. Well, why? Because we used leverage, right? We didn't pay all cash. We're getting leverage appreciation numbers in the 17 to 20% range when you first buy the building. We're looking at existing cash flow or a path flow to cash flow in the range, depending on what the property is, 3 to 5%. But again, we're going to be conservative. We're going to stick to the lower numbers. Same thing with our equity buildup through the loans and our tax benefits. We're going to say 3% for those as well. And as an example, we can achieve a total return of 26% on those investments. Any questions on that? Does anything look sketchy there? Or?
This is important, because this is where they show the money. Does anybody got questions on this one?
No, we're good. So also part of the discussion is we're talking about the power of leverage and how great it is, but something happens with our leverage depreciation over time. So you see these numbers, we're going to move through our investment year to year. What's happening to our leverage depreciation here? It's going down. Does anyone know why it's going down? Pardon? Exactly. So this is our gross equity. So remember, we're appreciating a little bit every year, right? We got 5% on our market value building of $500,000, and we're up to a market value of $525,000. So our equity grew by our appreciation, and that continues to happen. So we have $125,000, which was our initial down payment in the property, and our equity's built up over the next 3 to 4 years up to $200,000. But our leverage appreciation's gone down to 16. So the only way this plan is going to work for the time value of money and hitting our future values is repositioning our leverage as appropriate. Because if we just buy one building, we pay down our loan, we owe no money, we're not going to turn $250,000 into $21 million. It's not going to happen. So we have to be able to re-leverage as appropriate to reset our leverage depreciation. So this can be done through a 1031 exchange. So here's an example. Our equity's grown to $203,000 in the building that's worth $578,000. So what we can do is we can sell that building, and with our $203,000 of proceeds, we can buy a building at $812,000. And now we are appreciating on a higher building value and, again, pushing our gross equity numbers. So we're always letting time do its thing, and then we're able to get into progressively more expensive buildings to let the exponential part of the equation start to kick in. Does that make sense? Okay, great. So this is an example if we weren't doing any 1031 exchanges. So all we did here was graph our current equity, right? We're going to put in a couple of $100,000, and our loan balance in year 30 is going to go down to nothing. And our building's still going to appreciate. We own it all cash. It's awesome. But it's going to take 52 years, and we're going to be somewhere around $11 million. I don't know about you guys. I don't have 52 years to get my money. I got to do this a little bit quicker, right? So when we put in the same graph and the same 51, 52-year period, look what's happening to our loan balances. We're progressively owning more and more real estate and higher values. So we're actually borrowing more and more money. But look what's happening on our current equity in 51 years. We're not talking about 11 million. We're like up near $500 million, which is just insane. It grows and it grows. So this is just meant to be a visual representation to let you guys know that releveraging when appropriate is very important. So typically we see that when you get equity in your building of in the 40 to 50% range. That's kind of like a signal to say, okay, I have somewhere between 11 and 14% leveraged returns. So I've got to get into another building. I got to sell this one, or I can just cash out refi and buy another one. Beauty of that is both of them are, non-taxable events. So I actually want to share a couple of deals with you guys on our pro formas. So for my first example, I'm going to use a 4-unit property in East LA. This is an actual deal for one of my clients. We closed when did we close? January. We got into contract, I want to say the week of Christmas. It's my favorite time of year. Everybody's sleeping, great time for deals. So 4-unit property, East LA, $810,000 is the acquisition price. It's about 2,000 square feet. 25% down. We use 2% closing costs. We put in a renovation of $25,000 because the front unit, being a 3-bedroom, was vacant at close of escrow, is the deal we made with the seller. Total initial investment of about $244,000. So these are the pro formas we use. We're able to model for everything. We've got our proposed financing in here. It's conventional. You can see 75% LTV, the interest rate, monthly and annual debt service. We account for that. We've got some great metrics here. GRMs and cap rates, not only at current rents, but at market rents, which is very important because when we talk about a pathway or being able to cash flow, we have to unlock the hidden value of these buildings. Because people look at it and they say, okay, why am I buying this? What's so great about this deal? It's not really doing much now. We're more concerned with what you can turn the deal into as long as you're buying it right? We're not overpaying for anything, regardless of how much money you can make with it down the road. We have to make sure that we're in line with the market. So these metrics kind of really help us on this, especially with the larger commercial properties where we're more focused on cap rates than, number of bedrooms and price per square foot. But obviously for 4 units, we have to pay attention to those. So this particular building is showing current rents at $5,500 with market rents of 4%, because that's all you're allowed. This is actually not LA City, but unincorporated LA County, because it's right on the other side of Indiana, if you guys are familiar with the Boyle Heights area. So right now, the LA County Board of Supervisors is saying, hey, no rent increases. Cannot do that, but you can in July. So we are modeling for our upside, knowing that within the year we can capture our upside. Although we were getting the front unit vacant, still modeling for the rents we can get right away once we get a tenant in there, which has already been done. Kirk, can I get you to slide me up to get to the good stuff? A little more. And over to the side. There you go. Thank you so much. So briefly, we have repairs and maintenance on this property at 5% of gross scheduled rents is what we model for. We model 5% vacancy allowance right off the top of the rents before we even get to expenses or anything else, because we want to have money in reserves for when units turn. So we're financially accounting for vacancy, property taxes, insurance, repairs. There's no property management on this deal. My client owns other buildings in the area, and he's like, okay, I'm just going to manage it. I'm going to take care of that myself. Utilities, about $60 a month. It's water only, $60 per unit per month, $2,880. You probably won't do pest control or gardening, but we're accounting for that anyway, should you so choose. So we're looking at about a 30% expense base. It's roughly $19,000 on this property. Our gross scheduled rents, now that we've got the new tenant in, we're getting $66,000. So when we go through our, excuse me, our pro forma, we're able to get our net rental income, subtract our expenses, which we're just carrying over from our operating, and we're left with our NOI, so net operating income. Obviously, that's the number we're using to calculate our cap rates, right? We're subtracting all of our expenses from our income, and that's giving us our NOI. So that's an important metric, obviously. And then we have to subtract our debt service, and we're cash flowing about $9,000 right out of the gates. So this is a real world example right here, heart of Los Angeles, cash flowing property. Well, great. We were talking about how we're giving you guys like 25% sustained annual returns, right? Well, we got to show you how to get there. So when we're averaging out, again, our gains from appreciation, that's our long-term average, remember. 5%, it's $40,500. We're using leverage. Well, we're getting 16.6% return there. And our cash flow on this one, and again, the numbers that it's pulling here is actually our pro forma numbers. So that's our little 4% rent bump within the next 12 months. This is what we're looking like in year one. 4.7% cash on cash return, which is fantastic, right? We're in LA. You don't have to leave home. You get it right here. Tax benefits worked out to 2.2%, and the equity buildup on amortization is 4.5%. Total returns, again, long-term average across the first 3 years. Are we exceeding our 25% target here for return on equity? Anybody? Yeah, I'm getting a lot of affirmatives. So this is a typical, I call it a bread and butter deal, right? So yeah, all the metrics higher up are important, right? What's our GRM? Are we buying it right? What's the price per square foot? All of that goes into the acquisition strategy. And can we get it at the right price? But once we move past that, this is what matters to me. Am I getting from where we're trying to go, from where we are now? And all these expenses, because we're working on the buy side of the equation, are actual. So we're investors too. We're not telling you the insurance is $1,600 and you go to buy it and it costs $2,500. It's not what it costs. Same thing with our utilities and pretty much everything else. So these pro formas are meant to guide your decision making. Does this property work? Does it work for me? Does it fit within my plan? That's what we're looking for. And that young lady in the white sweater.
Can we take the next 5 minutes for questions? Is that okay?
Yes, we can.
Can we take the next 5 minutes for questions? Because you're done presenting this case study, right?
Yes,
'Cause
this
I'm
case
sure
study is done.
People have questions, so let's have some questions. Nobody has a question. Okay.
We have a question.
Well, before you get in at 810,000, how do they find it? Because that's a pretty good deal for it.
So this property is what I like to call, with a lot of my deals, it was hiding in plain sight. So what does that mean? It was on the market. It went into contract with an FHA buyer. And they went through the process for 60 days before they figured out that the rents won't pass self-sufficiency. I could have told them that in the first 5 minutes, but somehow they stuck with the escrow and they couldn't get the loan. So it's already showing on market from the first go round, and it quietly comes back on the market, and no one's paying any attention to it because people love new listings. They want to write offers. It's new, it's hot, let's get it, let's throw money at it. Nobody looks at the old stuff. The old stuff is great. The longer it sits, the cheaper you can get it. So we actually came in and asked some questions. It was listed on the MLS, and sometimes the information is not as it should be. So they listed the rents as if the vacant unit wasn't going to be vacant. They just put the old rent on it. It was $1,000 less a month, which is $12,000 annually. So if I would have put that in my pro forma, this property doesn't cash flow. But we call. The property looks interesting. Let's call. Let's get the story. Are you guys able to, make a deal? Cash for keys. Would you be interested in moving out a tenant? How eager are you to sell the property? So we actually, used those strategies, but this one actually turned out to be easy. We called up and they said, oh yeah, and the tenant in the front, they're on their way out. I'm like, oh yeah, the one paying $1,600 a month? It's like, yeah. I'm like, great, market rents are $2,600.
Just don't rent it before we can sell.
Yeah, well, they wanted to sell it empty to make it more attractive. And we literally, we just walked in, we got it. There's nobody else there. I mean, we weren't up against 6, 8 different people. And it was actually listed, I think, for $10,000 less. But they said they were in contract at that number. I said to my buyer, if you want to do it quickly. We know the numbers make sense, right? So for us, listing price is one thing, strategy is another. So here's the strategy. Are we doing the numbers? Yes or no? Yes. Does it work at 810? Yes. Will you pay 810? Yes. Let's give them the value that they think it's worth so we can get into contract before someone else comes to the party. So everything we're doing is leveraging our buyer qualifications. We're leveraging our professionalism, and we're just going the extra distance. We know how to make these properties work.
So you get this off market, correct?
No, it's on market deal.
It's on market. Okay, so
Listed in the MLS. Anybody could have bought this property.
so when you found out that it was, you personally found out that it was a good deal?
I ran the numbers.
You ran the numbers. Okay, so when you ran the numbers, who did you hit up, and did you give it to? So you.
No, I was looking specifically on behalf of one of my clients. I mean, as easy as this deal was, we actually had the only 2 failed escrows I had all year was for this buyer. Third time's a charm. We actually canceled 2 escrows before we got this. So it's not all rainbows and unicorns also.
You didn't put it out to, like, I'm sure you have quite a few people that you work with. You didn't put it out to everybody. You have one specific.
I have
buyer.
one specific buyer in this area, and this was the one.
So that specific buyer wanted to buy in that area.
Yes. Yeah.
Were any of the other 2 escrows up for inspection?
Oh, the other ones for that client, one of them didn't get us the right due diligence that we wanted, so the comfort level wasn't there. And then on top of that, we made a request for repair that they didn't like the number. So we had to walk away. It just didn't make sense, given how much work the property needed. And the second one, we ran into city inspections. With the city of Compton, there was a lot of work done not according to permit, the addition of bedrooms, the addition of a bunch of other stuff. And at the end of the day, the seller said, they're going to make me do everything. If I sell the property, I've spent enough money, I'm not going to sell it. We'll go to court. So I said to my client, you want to go to court? He's an attorney. He said, no, let's get something else. So we were compensated for all our expenses, but we hung in that escrow for like 5 months. Walked away and just walked right into this one. So everything works out.
Any other questions in the room, guys? Yeah, go ahead.
How
The
long-
earnest money, when it's falling out of escrow, like, is the earnest money? Like
The earnest money in both of those cases, and that's a great question, because I kind of pride myself on that. Like when I work with clients, I take their money seriously, like it's mine. You know, if you work with me, we don't go all fast and loose with earnest money. We stay protected by the contingencies. So in both those deals, we still had all our contingencies in place. Nobody asked us to remove anything. They didn't say, hey, yeah, you know, you got the loan, you're ready to remove the contingencies. They don't ask. We just keep going. So the clients were fully protected, you know, within their, you know, allowable contingency periods. Escrows were canceled. They were paid back 72 hours. Money's in the bank. Anyone else?
How were you compensated?
Pardon me?
How were you compensated?
Knowing that I'm building the trust of a client and that we're going to get this into contract and we're going to do a lot more in the future.
Any question back here? Anyone?
Just a quick question. If something falls through and it ends up not working out, do you ever recycle a deal and re-suggest it to a new client, or you only go based off of what they're looking for?
Typically, that's kind of part of the process in working with clients. As part of the education, we look at certain areas. We look at how much money they have, what types of properties they want, and we specifically bring them the deals that cater to them. On the rare occasion, I've had a couple of different clients that I thought would be interested in the same property, and I'm absolutely sure that it would work for, you know, either person A or person B. And inevitably, when I end up presenting it to multiple people, sure enough, there's only one person that wants to go for it. Somebody has something where it's like, no, I'm going to take a pass on that one. I'm like, really? Okay. So it seems to work out. So the question I just answered was, how does it work? Do we recycle deals for clients? If, you know, something doesn't work for one, do we just bring it, you know, forward for others? And we just kind of haven't been in that, you know, in that space. And even with our off markets, a lot of them are from our own clients and go through our brokerage. So a lot of us are all trained the same way. They're looking at the same things I'm looking at. So when we get an off market, even within our own brokerage, I have, you know, maybe 12 other agents in my office that I'm competing with that may have buyers. So try and be better.
All right, let's give him a hand.